Hey everyone, it's Mike from Orderflows and welcome to the special presentation on the Orderflows Sequencing Indicator for NinjaTrader 8. Before we begin, just understand that trading does involve risk and you should only trade with money that is set aside for trading. Now, many traders don't realize that the different types of traders that exist in the two-way auction. Oftentimes they think that the market is simply made up of buyers and sellers, and while there are buyers and sellers in the market, it's just not as simple as it seems on the surface. And let me explain. Within the world of buyers and sellers, there are different types of buyers and sellers. There are aggressive traders, which are the aggressive buyers and the aggressive sellers. There are passive traders, which are the passive buyers and passive sellers. And if you've ever looked at the DOM, the depth of market, you'll notice that there are bids and there's offers, okay? And there's differences within that. So remember, the market trades in a two-way auction. So here we have a market that's 45.1975 bid, offered at 45.20. The 30 contracts that are on the bid here, these are passive buyers. The 36 that are below at 45.19.5 are passive buyers. The 54 sitting on the bid at 19.25 are passive buyers. The 32 lots that are offered at 45.20, these are passive sellers. The 56 at 20.25 are passive sellers. The 71 at 20.5 are passive sellers, and so on. Now, for a trade to occur, someone has to cross this bid offer line. If everybody that wants to buy is only willing to pay 19.75, they're not willing to pay 20, no trade will happen. Just as if no seller wants to sell below 45.20, no trade will happen. So someone has to cross the bid offer line. Either an aggressive buyer has to buy from the passive seller. That would be an aggressive buyer. Okay. Now, if someone crossed the bid offer and sold at 45.1975, that would be considered an aggressive seller. So you have passive buyers that work the bid and below. You have aggressive sellers that sell into the bids. You have passive sellers that are working offers, and you have aggressive buyers that buy from the passive sellers. Now, I'm sure we've all seen the time and sales, and nowadays the way the markets are, they move very fast, and it's very confusing if you're trying to watch the time and sales, because honestly you're not going to make anything of it. You can see here there's all these trades. This is at 9:16 and 18 seconds. Here it starts down at the bottom. Up here at the top is still the same 1 second, and you're seeing all these trades go through. Okay, so it's moving super fast. Now, if you've ever wondered what the different colors are, well, that denotes the type of trading that was going on, if it was aggressive selling or aggressive buying. All right, so there's information in the time and sales, but the problem is it just moves too fast. And on a DOM, you can sort of get a sense of what's happening in the market, but the problem is you really want to keep track of what's happening in the actual trading. Now, the bids and offers that you see on the DOM are just levels that people are willing to buy at, or levels people are willing to sell at. And the market doesn't always trade to those levels. Sometimes you see big orders going in and then getting pulled before the market trades there. Sometimes, not so much nowadays, but in the past, people love to play games with putting in size and pulling it, etc. But looking at a DOM doesn't really give you an accurate indication of what's happening in the market. Okay, time and sales, which is the actual trade recap of what happened in the market, is going to be more useful because you can see the volume that traded at price and whether it was traded aggressively. Okay, whether meaning it was aggressively bought or aggressively sold. And this sort of comes into the next segment on order types, right? Because again, you see these orders going in, getting pulled, trading, etc. But big orders, right? The orders that have an effect on the market. And who works the big orders? The big traders, the institutions, the banks, the hedge funds, the CTAs, the hedgers, etc. They have big orders to work, and this is E-minis. And if you've got to buy 1,000 E-minis, well, there's not enough liquidity in here. Okay, you're going to move the market one way or the other, especially if you plop in a 1,000 lot order jumping on the bid or work an offer, it's going to have an immediate near-term effect on the market. It might scare some people away, or it might attract the opposite side. And nowadays there are banks, the prime banks, which are prime brokers now for the hedge funds and institutions. They have their own suite of execution algos. I mean, there's a whole, what do you want to call it? I've been saying this for years. There's an arms race among banks to offer the best execution algos, because there is what they call execution alpha. If you are a big fund, well, you don't even have to be a big fund, but if your orders are 100 lots and up each time, a simple thing as a half of a tick improvement on a fill over the course of a year is going to help your bottom line, right? You want to try and beat the existing bid offer that's in the market. And how do they do that? Well, they have these different execution algos. I'm just going to do a brief summary on them. I mean, it's fascinating if you ever get a chance to sit down with somebody that has worked at a bank, and you just sort of talk about these things if you're into that. But there's liquidity seeking algorithms. Okay, now these aren't there to try and pull tricks on the market, etc. They're there to fill orders. So these algorithms, they're created because big traders have big orders that they need filled without impacting the market. And the first part that I'll talk about is what they call liquidity seeking algorithms, right? And it takes the available liquidity without showing the order to the market, right? You don't want to just show every trader out there basically what you're trying to do. Okay, you want to hide it in some way, and in the old days, hedge funds, had their own brokers that they like to use, because the guys on the trading desk knew how to fill the orders without impacting the markets. Now, it's all computerized. Okay, and what these liquidity seeking algorithms do is, they keep track of the fair price, and they wait for replenishments at that fair price while continuously computing the dynamic fair price. Okay, and so what's going on is, the algorithm is deciding while the market is bid offer, is this a fair price? It'll keep working a bid. If it thinks the fair price is moving, it'll probably start lifting the offer. There's all many different ways that it works it. Okay, and what it's going to do is it's going to keep crossing that spread, the bid offer, as long as it's the fair price still. If the fair price starts moving, it's going to get aggressive, right? And it's going to start crossing the bid offer line, and then clear that out and potentially work a new bid at what was the offer, right? And start trading against the new offer. It's going to keep the, what do you want to call it? It's going to keep the order working as long as it's getting a fair price in the market. Okay. Now, another algo that is fairly common is the POV algo, the percentage of volume, and that allows you to trade large orders with minimal market impact, right? Basically, what you want to do if you have a big order is you want to participate in the trading that's going on. So it's going to work passive orders, trying to get better executions, but as soon as the filled quantity falls behind, the POV algo becomes aggressive and catches the spread to catch up on the order. So again, if it's working a bid but more is trading on the offer, it starts getting aggressive, starts trading more on the offer. It's participating at each price that's trading, basically, is what a percentage of volume is. You set it to whatever, 20, 25%, and you're 32 on the offer. If 5 lots trade, it'll buy one, right? Or if it's a buy order, it'll work some bids in here, it'll work them all the way down a few levels, as well as monitoring how it's trading on the offer side. Basically, it wants to participate at each level. Now, the reason why I talk about that is because I sort of want to get into big orders do have effects on the market. Okay, and there's different ways that traders nowadays are able to work them. And if you're watching the order book, resting liquidity, the volumes are constantly changing, right? Sometimes there's going to be big orders that flash up in here, Okay, like here you see 228, 328, 170 when you just see 63 here. It's constantly changing, and honestly, trying to keep track of it in your head is not always the easiest thing to do. Especially if you're trading some of these markets. Right now it's mid-March, and there's all this crazy stuff going on in the world, and the markets are jumping around very fast. E-mini S&Ps is a very tight market. It's just one tick bid offer. But sometimes crude runs into these periods where you're looking at a 5 or 10 tick bid offer. Wheat, Nasdaq, don't even get me started on that market. It jumps off the DOM. Sometimes it just gets moved so fast because there's just not a lot of liquidity in there. Now, the order flow sequencing, okay, is basically when you have a stacked order book exists, okay, meaning subsequent more volume going up in the offer, right? Remember, I explained how those algos work, right? So if someone has 1,000 E-minis to sell, okay, it's just not going to put an iceberg order, sell 1,000 E-minis at 45.20.5, right? It's going to, what it does is it chops up the order, and it'll put some in at 20.5, 20.75, 21, 21.25, 21.5. Then it's going to hold some back, and in case it needs to start hitting bids and big orders. That's how big orders are worked in the market. Again, we all hear about the almighty iceberg order like it's some great thing, but in all honesty, every order that's above probably 10 lots in some ways is often iceberged in most markets. I say 10 lots, maybe anything over 50 lots tends to be iceberg nowadays, and has been since my goodness, for the last 20 years, I'd say it's been like that. And when you have a big order, right, you're going to stack the order book, okay? But just looking at a DOM, you can see, well, yeah, here it's a screenshot. It's stacked, right? It's 25, 47, 51, 56, 62, 67, 87. And this is just what's showing. There's probably more behind the 47, the 51, the 56, the 62, the 67, the 87. But again, it's constantly changing, all right? And more importantly, this stuff hasn't traded yet, okay? And so that's not going to do you any good looking at a DOM. Yeah, the order book is stacked, but so what? It hasn't traded. It doesn't mean anything. Anyone could throw in, well, not anyone, but you need the margin, but anyone could put in a big order, sell 620 just to impact the market. Now, sometimes, people think that anytime there's a big order for size, the market's going to immediately move away. That's not always the case, okay? Oftentimes there's a big order shows up in the market. If there's another big trader out there, he can just scoop that up in one fell swoop. Now, when you see a stacked order book, okay, that's just a clue, okay? But the problem is, looking on the DOM, it moves too fast for you, right? And by definition, big orders, right? If you know there's a big order in here, that should hold the market down, right? It should put a cap on the market, right? After all, that resting liquidity is hidden, and it's like running into an iceberg in a sense, like not just an iceberg order, but imagine an iceberg ship. Imagine everyone is buying it here, but there's actually 1,000 lots offered here at 21.5. Everyone's buying it, and then is buying it, and then they can't buy anymore until their ship sinks. Okay, so in theory, right? That's theory, is big orders should hold the market at bay, and they do, right? I just want to call that a theory, but they do that sometimes. But you really got to be thinking about what's happening in the market. A big order should hold the market down. When I say big order, I'm talking about a big sell order, okay? In terms of buy orders, it would be the opposite. It's just a big buy order should support the market. So a big order should hold the market down, but it isn't oftentimes, right? In fact, the opposite is happening. The market is working its way through. The market is strong. And what do I mean by that is, going back to the DOM, if here, right, you see the big orders, right, and the market is eating its way through these big orders at subsequent levels, right, and I know that it's a sequence of more volume, more volume, more volume, more volume. And when I say more volume, I'm talking about the price level right before. Okay, so obviously the 105 is not more than the 114, but again, this is just the order book. So if you see a book, an order book, and you see big size and it trades, now this is where people get confused. They see, well, there's 328, then the next thing they know, it's 45.40 bid, but maybe that 328 got pulled, right? And only 75 contracts actually traded there. I mean, that's sort of these games that these algos plays. If they're working an offer up here at 45.40 and the market starts trading up there, well, they just back off, and because they know they could probably sell it at 20 and a quarter. If it's 40 bid, they could also sell the 40s that way. But anyway, keep that in mind, okay? Because you want to be trading in the direction of strength, right? Whether it's buying strength, where the people are buying subsequent bigger offers, right? Or selling strength, selling subsequent bigger bids. And basically what it comes down to is when sequencing, you're going to see subsequent higher volume being traded at each level for bullish sequencing, or subsequent higher volume being sold aggressively into passive buyers on the bid side. So it'd be like 12, 55, 62, 80, 100, 150. Okay, that would be a bearish sequence. A bullish sequence would be if everything just got taken out, even if it was at these levels, 25, 47, 51, 56, 62, 67, 87. Now, sort of before we move on, again, resting liquidity can be difficult to understand because what you think should happen often doesn't, right? This is an order book, okay? In the old days, 10 years ago, people would put out trading courses, okay? They'd show you a picture of a dome like this. 41, 99, 73, 124, 102, 113, 110 on the bid here. So you're seeing it's more on the bid than more on the offer. So they say, well, you should be buying this offer. Well, what happened here is the market sold off, right? Because everyone's saying, well, you got support in the market. You can see it all here in the book. But what they fail to understand is what is happening in the market. You have these bids, right? You have these execution algos, these smart, computerized programs out there. They're working these bids in here, but the market's starting to trade down. So what they do is they pull it out. They pull that liquidity out. So even though this market drops from 36 down to 35, it doesn't trade 124 here. Maybe it trades 86 because it pulled 50 lots out of there, because it's knowing them. It's seeing the market's dropping, so it's removing its bid, moving it down to 25, removing its 25s down to 35 even, and so on, right? Because now that they're working to get better fills for their customers in that direction. So, sort of it becomes like candlestick patterns almost, in the sense that, yeah, sometimes the resting liquidity works, sometimes it doesn't. Now, that's not to say that it never works. Of course it does, right? If you've ever watched, a heat map, right? You see these resting orders. Now that's a different type of order. Oftentimes, if you see like on a heat map, a line going across, a big order, and it's been there for days, well, that's probably what they call paper, right? That's an order, a legitimate order that's been sitting in the market. It's probably not going to get pulled. But when you see stuff like that, it does have its significance. But back to the DOM and time and sales. Problem is, this moves too fast here. This is 9:45 and 53 seconds. This is 9:45 and 55 seconds. And the problem is everything in trades is a one lot. The average trade size, I think, in the E-minis is just under 2 contracts. I think it's like it's like almost like 1.5, because these algos, they chop them all up. It's, even though the order's for 1,000 contracts or whatever, it chops it up into the smallest size, one lot. And you can see how it traded on the bids, and you can see how it traded on the offer in the time and sales on the DOM. I mean, now they got smart DOMs out there, which will show you volume for a certain period of time that you can refresh and all that. But again, it's just a DOM just gives you people's intentions of what they're trying to do, not what they're actually doing. The time and sales tells you what they're actually doing. You know, somebody that's in a trade is committed to the market, right? They have to make a decision one way or the other at some point to get out. Now, what if there was a way, and there is a way, to take all this information that you're seeing on the time and sales and put it in easy read format? Well, that's the footprint chart, okay? And, you know, footprint charts have existed out there for, 20 years or so, and there's a lot of great information out there for traders to take advantage of. And if you know what to look for, you can see where this sequencing occurs, right? There's a lot of numbers here. People get scared looking at a footprint chart. But if you know what sequencing is and understanding it, where there's these big orders in the market, right? And again, if it's bullish sequencing, it would be happening on the way up. If it was bearish sequencing, it would happen on the way down, right? And here's your bearish sequencing right here, right? The 28, the 142, 145, 164, 418. So there was a buy order in here, or buying. It doesn't necessarily have to be one order. It could be a couple big orders lumped in together on the same area. But what you have is you have someone that was interested to buy it here. Again, this was the 25th of February, right? The market was going up, came in here, there's a big buyer, right? And people say, well, there's a big buyer. Shouldn't the market go up? Well, in theory, yeah. But what's happening is traders are working hard selling into this, what do you want to call it, market generated support that's happening right here, this big buyer coming into the market. But at this level now, again, it's not, it could be the aggressive selling that's taking place. It could be one big seller, it could be somebody with a lot of supply, people that want to take profits, a combination of a lot. But what's happening is the market is working to get through that big buyer that's potentially offering support right here in this market. And who's winning? Well, the aggressive sellers are winning, right? Because at the end of the day, what moves the market most is the aggressive trading. I don't want to say always moves the market is aggressive trading, because if you have a big passive buyer or a big passive seller, that can stop a move very easily. But this market is moving, it's working to fill that passive buyer up here. And it's working hard. It's stronger than the passive buying. The aggressive selling is stronger than the passive buying. But seeing it on a footprint chart can be difficult because it's not easy. It takes a trained eye, and you really got to focus your attention. Maybe people that trade on a DOM would want to look for it on a footprint chart, but to be honest, you don't need to, right? You could have software that does it for you. So again, if you're looking at the chart, you're trying to figure out, okay, well, you're 16, 37, 97, 94, 118. Oh, that's not it. Okay, now we're going down. It's just easier to have software that would highlight it for you, and it's right here, 13, 31, 75, 112, 231. Okay. And then the market went up after it got through this big size here. There was big offer here. Someone had some supply to sell when the market worked its way through those levels. So again, sequencing does exist in the market, and the way you can see it is you need a footprint chart, or you got to train yourself to see it on the footprint chart. But that's difficult for a lot of people. That's why we created the indicator, the Orderflows Sequencing indicator for NinjaTrader 8. Now it runs on NinjaTrader 8. It's not on TradeStation. It's not on Sierra Charts. It's on NinjaTrader 8 because that's the software that I use, right? I create these tools to make my trading easier. That's how Orderflows got started, was to make my own personal trading easier. And over time, people would say, Mike, I need this tool. I need that tool. Can you do this for us? So yeah, that's why we release these indicators, and Orderflows Sequencing is one. So this is E-minis yesterday. You can see where the sequencing is coming in as the market is selling off, as the market is rallying. Now, on our footprint chart, the Orderflows Trader 5.0, which we released the 5.0 version earlier this year, it's available. And the thing is, on the footprint chart, right, what we have it as is just showing you on the footprint where sequencing is. Because traders that use a footprint chart tend to be active traders, right? They're actually there monitoring the market, and they're putting what they're seeing in context of the market. Because at the end of the day, even though if you know where sequencing is, you still need to know how to apply it, which ones to take or not. And that's why we created the Orderflows Sequencing Indicator, which basically does that analysis for you. So when you have the sequencing, it's going to tell you, when to take the trades rather than just, oh, there's sequencing here, right? You want to know which trades you should take. And, honestly, we've got the settings. They're very simple to use. There's very few settings you got to worry about. You have the cluster size, 5 is the default. A swing period, whether you want to be taking it at swing highs or swing lows, right? You would enable that. Or if you just want to see it anywhere, you would just disable that. We have a sound alert as well. So, if you want to enable the sound alert, you can, have it running on your computer, do your other thing, and then, if sequencing appears, you get a ding, alert, sequencing or whatever sound you want to have. We have the trade entry signal, which I'll talk about later, and the visuals. You can choose to have like a zone drawn out over a certain amount of bars, or if it's until tested again, because the market will often come back to those levels. Sometimes they will hold, sometimes they will not. And I'll just run you really quick through, sort of some of the settings. Now, in the user guide, I talk about, different settings for different markets and all, but I just want to show you, a couple of the different charts here. So this is with a cluster size of 3. So it's looking for a sequencing of 3 and, a swing filter of 1. So it's got to have, a recent high or a recent low. And some markets you would use 3, some markets you would use 5. So markets that aren't as volatile, for example, like interest rates, you'd use 3. Markets that are more volatile, stock indices, you'd use 5. So this is Bunds on the 25th. Obviously, you had that nice move down, but you can see how it's picking, almost these nice turning points in the market. Sometimes there's sequencing that fails. Okay, fine, but you know where you're going to be getting out. That's why we draw these zones. You can have them drawn until they test again, which I'll show you in a bit. This is Ultra Bonds. Okay, so you can see it's catching the nice major moves. But again, there are a couple small losses here and there, but unfortunately, there's nothing that's 100% in trading. Here's Euro currency. Okay, you see it's picking nice turning points here. Now, zones. Okay, I said you can have these zones drawn out. Like here, this is drawn out 5. I like to use these zones for, just so I can see on the chart where my stop should be if it starts trading back into those zones. I want to be getting out. You can choose not to have those zones. Okay, so for example, here, this is mini Dow. This is with no zones drawn out. Okay, so you can have it drawn out, 5 bars, 10 bars. You could adjust that or whatever you like. Or you could have no zones. This is no zones. Or you could have it drawn until tested. Okay, and you can see here, look at this, came right down to that level. Here it came right to that level. Here it came to the level, sort of spun around. Here it just went right through. Here it just went right through. This one hasn't been tested yet. Here it sort of came up here and went through, but then just sort of hung around. Now, there are people that love to trade these types of levels. They'll just throw an offer right here. They'll throw a bid here, okay, with their stop just on the other side of the zone. Okay, so there's different ways to trade it. I like to use these zones for my own trading. One, I know where the stop is going to be. All right, but obviously, if a market sells off here and I get another signal, I'm not going to still hold this short and come back up here and get out. These until tested zones are for people that want to work bids and offers for retests. But again, it's not where the market always comes back to that level and reverses off that level. Sometimes, the levels are fantastic. Like here, this was Ultra Bonds, came right to that level and shot up. There's E-minis, and then even in the European hours, right, it came right to that level and sold off. But again, there's different ways to trade it. Me, I just like to take the trades as soon as they happen, I don't necessarily trade for the retests, but if we're coming back to that level, I may throw a bid or an offer in. Here's, what is this, gold? All right, you can see it came to this level, came to that level. We got some open levels here, some small levels here, a small level here. There, crude oil. Okay, obviously crude's been very volatile over the last month, but you can see how these levels, can give you some low risk entries, if you want to trade it that way. Personally, I think you're better off taking the trade initially, and for a second trade opportunity when it comes back to a zone. Here we go. This is crude oil from taking levels from the previous session. Right, you can see it comes right to that level, comes right to this level, comes right to that level. MES. Okay, it blew right through this level, came right up to that level. These levels got right through, and this is the open one going into the weekend. Now, the other thing I want to talk about, one of the settings that's important, is the trade entry signal. And what the trade entry signal does, I have this on all my indicators, is it confirms whether you should take the trade or not based on what happens in the subsequent bars where there's a signal generated. And you could adjust it, you could enable it, you could disable it, you could adjust how many ticks the market's got to move over how many bars. I use 2 and 2, and the best way to explain it is to look on a chart, and you can see where these circles are. There's no up or down triangle, right? So the conditions were met in the sequencing, but there's no actual signal. The signal is the triangle up, the triangle up, the triangle up, triangle down. So it's keeping me out of these trades here, it's keeping me out of this short here. Obviously this short kept me out of, it went down, kept me out of this long, kept me out of this long, which probably would have stopped me out on this red bar here, and this long up here. So while there was one nice trade that worked out, it kept me out of this losing trade, this losing trade, this losing trade, this losing trade, this losing trade. Because if I was just taking any time sequencing occurred and there was no follow through order flow, it would show a sell signal here, a sell signal here, a sell signal here, a buy here, a buy here, and a buy here. Okay, so I'm fine to pass on this trade, even though this trade worked out, because it's keeping me out of there's 1, 2, 3, 4, 5, 6, actually 7 here. There was a signal here, but no actual trade entry signal here. So 7 trades, 1 of which was a winner, so 5, 6 were losers. Okay, so imagine you can take out a chunk of your losing trades when there's no follow through order flow. So if you want to disable it, right, you would take out that check mark there, and then all those signals would show here, 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 up here. Okay, so me personally, I use the trade entry signal on pretty much everything, except for 1 or 2 very slow moving markets where I want to see what's happening. But it's just an extra filter to keep you out of trades that don't have that follow through order flow. Okay, so I hope you guys found some value in this training. If you're interested in the indicator, go to orderflows.com/sequencing/index.html. The link is below in the comment section, as well as in the description section. So you can just click on that. And I really think it's going to help a lot of people in their trading. The beauty of it is you can add it to your normal candlestick chart, right? You don't need to look at a footprint chart. Right? Footprint charts are great, but I do understand that not everybody is going to use a footprint chart, or not everybody wants to use a footprint chart, right? Because at the end of the day, footprint charts are great, but it takes time to get used to what you're looking at, right? And some of us are older, right? We go into things kicking and screaming, and it's just easier to put the information, right, the trade signals you're going to look for on a footprint chart on a normal bar chart. Okay, so thanks for watching this video. Again, the Orderflows sequencing tool is available. Just click on the link below, and I'll see you guys on the inside. Take care.